Hello and welcome to Risk at Work, Risk Connect's educational web series. I'm Scott Fenstermaker. I'm the Vice President of Digital Marketing. Today we're going to be talking about who does what, getting the roles right in ERM. There are many different kinds of functions and relationships in ERM. There's an oversight capacity, there's an assurance capacity, there's modeling that takes place, there's reporting that takes place. And it's important when we set up ERM programs that we not only set them up according to what we know to be general best practices having to do with interests and conflicts of interest, and making sure that all of these roles are done by functions that are not conflicted out so that they can do the best job possible. But they are also governed by idiosyncrasies of the organization itself. What is the culture like in that organization? What is its view of risk? What is its view of risk as a strategic advantage? And so it's important when we set up roles and responsibilities in ERM that we pay deference not just to what we know to be generally correct, but we also pay deference to what is correct for the organization. And we have a great guest to talk about that today. A few housekeeping items as always. First of all, if you have a question for our guest today, please put it into the question field of your webinar software. If we do not answer that question during the course of today's broadcast, we will reply to you directly with an answer to your question. Also, if you indicated that you would like CPE credit for attending this webinar, please watch your inbox after we're done here today. We're going to send you a short 3-question quiz. You fill that out. You return it, and we will reply to you with your CPE credit. All right, he's been on Risk at Work many times, and he's so popular, we keep having to have him back. You know him as a consultant, author, and lecturer on enterprise risk management. He is a regular lecturer at York University's Schulich School of Business. His book, Enterprise Risk Management, Today's Leading Research and Best Practices for Tomorrow's Executives, is available online and at fine textbook bookstores anywhere. You can get his wisdom right here at Risk at Work, and you have to get it before it gets tariffed. Ladies and gentlemen, Rob Quail. Rob, how are you doing?
I'm good, Scott. Two things. First of all, you finally nailed the pronunciation of Schulich, so congratulations. And secondly, I think for the third time, you've said everything I wanted to say in my talk in your introduction, so we can just call it a day and go and talk about other things.
Are you telling me that I've goofed up Schulich for all of these times? I've been trying so hard, dude. I've been
No,
so careful.
I think you've got it down now, so that's good.
I think I've got it
Practice
down
makes
now.
perfect. Yeah.
It must be a fine institution if you are a lecturer there. So I want to pay it the utmost serious respect that I can.
Thank you. Appreciate it.
We're talking about roles and responsibilities, my man. Please take us away and enthrall us with your acumen.
Yes. Okay. Let's dive right in then. And we'll talk, first of all, we'll talk about the basics. What are the components of enterprise risk management? And there's a model I've shared before with 4 elements. You've seen this before. We have some kind of articulated framework that says how and why we're assessing risk. We have something that describes our criteria. We've done sessions on this before, risk appetite and risk measures. We have some kind of application across the enterprise to key risk and integration to other things. And we have some kind of bottom-up reporting, which most organizations spend too much time on, but that's another topic. And then all that, of course, is in the purpose of enabling conversations and decision-making about priority. That's the whole point of all of this. Everything to the left of that bracket is there in service of the thing on the right. So today, we're going to talk about roles and responsibilities and authorities. And we're going to talk about a specific aspect of that, and that is, what's the role of your ERM group, your CRO or equivalent, whoever heads up your ERM function. We're going to look at some alternatives in terms of how that might be set up and what's successful and how to match it with the needs and environment and the risks your organization is dealing with. But first, I want to get even more basic. To understand the role of your head of risk management, we need to spend a brief time on the role of the chief executive. We've talked previously about the board, in fact, did a whole webinar on board engagement and their role, but we haven't really talked about the CEO. I really like this quote from Drucker. The ultimate role in any organization, of course, of the CEO or equivalent is to be accountable for setting strategy and accomplishing it. This Drucker definition is fascinating because it centers so much on the relationship between the company and its environment, the outside. The CEO is the ultimate connection point between the purpose and action of the company and everything that surrounds it, stakeholders, available resources, conditions, markets, that kind of thing. And then there's another quote that I'd like to flash up here that takes this idea a bit further. This is from Alan Lafley, who was the former CEO of Procter & Gamble, published in Harvard Business Review back in 2009. And he talks about, first of all, the meaningful outside. So part of that is identifying stakeholders, customers, suppliers, business partners, creditors, and understanding all their expectations. Answering the question, what business we're in and what are we not in? So that is effectively establishing the mission, vision, and strategy of the organization. Then allocating resources to balance risk and return over time. And then finally, establish values and standards that should guide decision makers throughout the organization. So that's an interesting and I think insightful way to define the role of the CEO from a former CEO himself. What about the CRO or the head of ERM? What are they supposed to provide? This comes back to the even more fundamental question of what ERM is supposed to do. What is ERM? Gold standard definition I reference often in these webinars is the one from Robert Kaplan and at Mike's. And it consists of these four elements: challenging assumptions about the world and inside, communicating information using tools, addressing gaps that might exist in existing, that are unaddressed by existing control or management functions, and complementing and enhancing those things. So in reality, different companies' ERM programs can be very different from one another. And this is one of the reasons why I think this definition is powerful. It's in the piece that talks to this, that contingency theory paper, they talk about the diversity of different kinds of ERM programs that have been successful. And one of the ways they might differ is the emphasis on these four things. Is it more about challenge? Is it more about tools? Is it more about gaps? Or is it more about complementing other things? And what are the details of the manners in which they accomplish those things? So in designing an ERM role that's right for your company, what should you consider? Today, I'm going to discuss drivers of those things. So the factors to keep in mind, and then some design options to think about in terms of what potential role of a CRO or ERM function might be in your organization. So once again, and this is part of the reason why I wanted to conclude that Drucker quote at the beginning, there's this outside-inside perspective. Inside, we've got the organization, the culture, and its capabilities. That's the internal focus at the top. At the bottom, you've got the outside, the risk environment, and then strategy, which should be the linkage between those two things, the connection between risk environment and organization, culture, and capacity. So I'm going to take you through each of these three high-level characteristics in some more detail and talk a little bit about its implications for design for an ERM program. So first one, organization, culture, and capability. So the level of engagement of the board and CEO, how empowered is the chief risk officer or head of risk management function? Is ERM seen as a key driver of success or an add-on? How injected into decisions, structures, and processes is ERM expected to be? How activist an ERM function does your top level have an appetite for? Are we really looking for improved decision-making? Or do they just view the development or presence of an ERM function as a box tick? Now, if it's the latter, that's not very encouraging, but don't give up hope. There are ways if you're there and you're there to tick a box, there's still lots of things you can do to become more meaningful and relevant. And we've talked about many of those things before. But it's important to start with a realistic view of what is the expectation of the folks in the expensive suits. What else exists? So what other risk functions and capabilities exist? This is in part should be an offshoot of what risks are you routinely exposed to? How effective are those functions? What are we good at? What are the things about risk management that are already part of the corporate culture in the organization? How much of an influence do head office functions have over decision makers throughout? So are you a highly centralized or highly decentralized organization? That has implications for how you might establish ERM. Now there's this word that I actually hate, culture, just because it's so vaguely defined. But the aspects of this awful word that are relevant to this discussion are openness. How much effort will it take to get decision makers to tell truth to power? How much is about dialogue? How much is about command and control? How integrated are things? How well do the towers, silos, functions know each other and talk to each other? And then finally, about this area of organization, culture, and capability, how long have we been at this thing? And how invested are we as an organization in doing ERM? The next thing I want to talk about is strategic context. So this is now the outside, so the connection between inside and outside. This is now about strategy. Is this an organization that builds value by placing bets? Is risk explicitly already understood as a value source through things like mergers and acquisitions, project development, adoption of new technology, new products, entering new marketplaces, new services, experimentation and learning? Are they already good at, perhaps not formally, but one way or another, is there a history and an expectation of placing bets, of using risks explicitly as a source of value? Who owns the company or organization, and what are their expectations on how risk will be managed, how it will be identified, measured, actioned, and reported? Now, stakeholders might include regulators, customers, creditors, employees. Note, in my experience about the ownership thing, government agencies are much more complex environments to do ERM in. In fact, we did a whole webinar on that recently about public versus private sectors. In the case of public sector, stakeholder expectations are more complex, more changing, more unclear. And as I said, we've revisited that in a previous session. I think there's a link at the end of this one. Actually, we'll be sharing on how to get a quick access to that one if you're interested. Um, Risk appetite. So what is our overall willingness to accept risk? Is our risk appetite spider diagram a big or a small circle? Um, how are we about being resilient or about being proactive? Especially when you're talking about things, softer things like reputation. Are softer considerations like that a big driver of strategic decisions? This is important because it's trickier to measure and evaluate many of those softer aspects of business success. So if it's a dollars and cents kind of business, or it's a how are we valued by our stakeholders kind of business, there are different implications for what capabilities you need to have in ERM and what the opportunities are to add value to the success of the company. And then what environment did the entity grow up in? Think of a company such as my former employer, Hydro One in Ontario, Canada, and a long history of the electricity utility space in North America, in fact, around the world. And compare that with something like, well, in my country, in Canada, a number of years ago, we decriminalized cannabis, and we have cannabis growers. That's a big industry that grew up out of nothing in the course of less than a decade. So they have a different history in terms of how they manage risk and how accustomed they are to dealing with some surprises. Regulators or operators who used to operate as government departments and are now independent agencies have a different history. Successful startups that grew up and have now reached a level of mass and complexity that it's not so easy just to do all the risk calculations on the back of an envelope. All of these histories affect the potential role for a risk management function in the organization. Similarly, some sectors are so heavily regulated that it can impose specific requirements for risk management, financial services in particular. So risk assessment and disclosures are prescribed by regulation. This will definitely influence the role of your ERM group. And then the third thing I talked about was we've talked about the organization, we've talked about its relationship between risk and strategy. Now let's talk about the outside, the risk environment itself. So what kinds of risk are we most exposed to and interested in? And we will all have a mixture of these things. For those who followed along with these webinars, you'll recognize this topic and this three-level categorization. To the left, we have preventable risks. These are internal risks that are controllable and ought to be eliminated or avoided. Things like safety compliance, regulatory compliance, business process adherence, IT infrastructure management. The question we ask is how much mitigation is affordable and makes sense? So it's largely about preventative controls in that area, putting them in place and making sure that you're operating at the efficient frontier. So if your organization's priority risks are in this category of preventable, your ERM focus will be on control, standardization, assurance, monitoring and management of discrete events. Now flip over to the right-hand side, external. Some risks arise from events that are outside and beyond our influence or control. They're the ante to operate in your business environment. Things like changing economic conditions, breakthrough technologies, government policy, global economic drivers. So the question here is, do we understand these risks as an inherent part of the business we're in? Do we have detective controls in place to monitor them and recognize when they occur? And do we have ways to cope should they happen? So if your organization's risks are largely in this category, external category, your focus will be on two things: situational awareness. So if scanning the environment, understanding trends and changes and risk drivers in the external environment, and preparedness, mitigation. So business continuity planning, perhaps risk sharing mechanisms such as insurance or hedging. So we can cope if one of these nasties happens. Or if there are a lot of these and a lot of different events, how to optimize mitigation of those things. So that's where we might get into things like quantitatively modeling how all those different events play out and developing curves and tornado diagrams and all that stuff. And then once again, as in the previous slides, I put strategy in the middle. That connection between preventable and external. A strategic risk is where a company or a person voluntarily accepts risk in order to generate superior returns from its strategy. So this is things like M&A, technology innovation, outsourcing. So these are risks in the middle category, strategic, that are not inherently undesirable. What risks are we accepting, and are we realizing the benefits? So there's more of a strategic ERM function. It's less tactical than the other two. It's more about influencing thought and modeling opportunities and downsides to help us make choices about what risks we like and what risks we don't like. And then another dimension about the risk environment is this whole thing about volatility and severity. How much change is in the environment, or even internally, or in our activities, and how fast? Have others failed in our sector? Do we need to be steadfast, where we drive risk appetite as low as possible and try to manage through everything, or resilient, where we accept a high level of uncertainty and where we need to value rapid decision making and allocation of resources? So those are the three considerations in terms of design an ERM function. I still haven't gotten to the topic, which is what your ERM function might look like. So let's talk about that now.
Well, just one
Sure.
point I want to make really quick on this. This is a little bit of a tangent, but you said something when you were talking about external risks that I really liked. And when you talked about the mechanisms of external risk, you talk about business continuity and resilience, and then you also talked about mechanisms of risk sharing, like insurance, for example, which I wanted to highlight because classically, when we talk about insurable risk, which is something else that Risk Connect deals with, it's classically termed risk transference, which is a term that I've never liked and never been on board with for that reason. You called it risk sharing, which I think is a much better term, and I want to highlight for people in that when you embark on strategies like insurance, there's a mindset that you have gotten rid of the risk, that you have transferred the risk, and so when this thing happens to you, it's okay because you have insurance and you can clear your mental space of it and focus on different things. And I have not found that to be true in practice. I have found that you retain some risks even though you transfer the financial aspect of some risk. Were you deliberate in your choice of risk sharing there for that reason?
Yeah, I don't like the term risk transfer because it implies, oh, we're done with it. It's somebody else's problem now.
Yes. Yes.
Sharing is one way to put it. Another way to put it is actually transformation. So what you're doing is
Oh.
taking an exposure and turning it
Mhm.
into a commercial risk. So now
Yes.
you're no longer concerned about. So insurance is one, outsourcing is another example of what
Sure.
people used to call risk transfer. So
Transference.
basically, what you're doing is transforming performance risk into counterparty or commercial risk. And you're
Sure.
using bits of paper, and now the main mechanism for management of the risk going forward, which used to be if when you did it in house, your own operation, is now stuff that's written down on a piece of paper and how you're going to manage that relationship. And you'll recall, I think there was a webinar previously on examples of integration of ERM into other things. And one of the
Yes.
examples we gave was about outsourcing and about the important part of buying insurance or outsourcing or hedging or any kind of transition or sharing of risk with another party should involve some kind of explicit understanding of what are the risks involved the scope of work around the agreement, and which components of risk are assigned to which party, and how are
Hmm.
we going to ensure that that's clear and that the incentives for both parties are aligned with the interests of both parties, so that the outsourcer can get rich and you can manage your business effectively and focus on your core. It's a bit of a digression, but I'm glad you raised it because I think that is an important point. And I still see people talk about risk transfer, and it makes me go like this. That
I
there
know.
isn't such a thing.
There isn't such a thing. That's absolutely right. And even when you can offload some of the risk in terms of a commercial risk or transform it to something that where you paid back, like in practice, you're never made whole from the different kinds of risks whether it's reputational, whether it's cultural, other ways that can affect your organization. There's a tendency to think that you're made whole by having a policy against it, and to a certain extent, you accept that. But an example is less of an acceptance of safety measures because one has good workers' compensation insurance, right? And so you get used to thinking that a certain amount of workers' compensation payout is just kind of par for the course, and you kind of muddle along that way, and it deprioritizes the deprioritizes your efforts towards mitigating those types of risk, which has cultural impacts and all other kinds of impacts. Again, I'm sorry I'm digressing it a little bit, but important point. Your terminology was specific, and I wanted to highlight it.
It's a great digression, actually, and I'm just going to torture everybody by going a little bit further down that rabbit hole. Because just yesterday, I was on a call with a client of mine who is a regulator,
Mhm.
a national regulator here in Canada. And they were talking about the phenomenon that they are noticing where regulated entities are starting to regard fines as an expense.
It's an expense, sure.
So they budget for the fines they pay for noncompliance, and this is a big concern for them, as you would expect.
They just
So
baked it in.
they've baked it into their budgeting. Exactly. We're going to spend X $100,000 on fines every year for not complying with this regulation because it's cheaper than fixing our performance, and that's not really
Yeah.
the intent behind regulation. Anyway, so I took a
Anyway.
minor digression and took it to a big one. So let's go back to the topic about the role of ERM. All right, so this model, this is adapted actually from chapter 8 of our fine book, available to you in fine bookstores everywhere, by Annette Mikes, called Becoming the Lamp Bearer. So in it, she talks about 4 potential roles for a chief risk officer or head of ERM function. What happened is we've used the first edition of this book in our program at Schulich, and during one of the classes, some students in a breakout came up with this model. So I'm going to give credit to a combination of Annette Mikes and the 12 people who were in that breakout group. So I can't take any credit for this one, but there are two axes here. We have on the horizontal axis, how far are we towards providing independent assurance as opposed to support? And then the vertical axis between tactical, where we're very much at the work face, dealing with decentralized issues, as opposed to strategic, tightly integrated with strategy. And what they did on their breakout is they plotted these 4 different potential roles for a head of ERM or your risk management function into these 4 quadrants. So bottom left, we have a compliance champion. I'll talk about each one in a minute in more detail. Then we have expert. That should read modeling expert. Not sure what happened to my slide. That's modeling expert. We're all experts. Top left, strategic controller, and top right, strategic advisor. So let's go through these in turn, and let's start with the bottom left, compliance champion. So what is a compliance champion? So they develop tactical responses to risks. They have fingers in a lot of the organization at the working or decision-making level. They might catalog the risk. They're mostly going to be internal controllable types of risk because we're talking about that kind of exposure. They'll figure out what the big ones are. They'll decide on approach to manage those things, maybe in the context of risk appetite. They'll set boundaries, standards, or limits and communicate them and use whatever stick is available to them to try and enforce those standards. So that's the compliance champion. So if you think about the role with regard to management, they establish policy and standards that are directed to decision makers throughout the organization. They do some kind of monitoring or verification that those standards are complied with, and there usually is some kind of communication reporting to the board with an assurance kind of point of view, saying that mess of regulations we've translated into standards or procedures or policies, and we are in compliance, or mostly in compliance, or we've had X non-compliance events, and here's where they were, and here's how management's responding. So there's some benefits to this approach. There's clarity in terms of risk ownership and tolerance. So decision makers know what's expected of them, and we have a consistent way, because we have this centralized group that's so powerful, of talking about risks. So if the risk environment is complex and you're depending on a lot of people to do the right thing, this kind of role can be a valuable function. It can give senior executives a nice warm feeling. It allows you the organization to persevere rather than adapt. So it's not a particularly agile way to do ERM, but it's certainly a steadfast and steady way to do it. Your role is to program uncontrolled risks out of the business. There's some disadvantages. First of all, this kind of function is resource intensive, obviously. You're touching a lot of areas of the business. You need to do it right. It can blur accountability or weaken management authority. So if something blows up, is it because the standards are wrong, or is it because the decision makers made the wrong decision? Who knows? And it may not be all that popular. You wouldn't expect to be on a lot of people's Christmas card lists if this is your function, because you are constantly butting up and compelling decision makers to do something different than they would have otherwise. And that's not going to earn you a lot of fans. So that's the bottom left quadrant. Now let's talk about the next one, modeling expert. So this role has a support function, but they're tactical. So what does that look like? They develop models and processes and information systems. They quantify things. The risks are complex. They're too complex for decision makers to fully grok. I like that word, grok. Maybe you're operating in a complex environment. You have to make big, messy decisions with a lot of drivers and actors and a lot of value at stake for a long time. So you're facing large bets. There's a lot of complexity. So you're going to need some quants, some PhDs in math, to model risks and communicate the conclusions simply to decision makers. So you look at alternatives with long risk exposures or potential for complex losses or volatility or deviations from plan. There's lots of data. There's many drivers. There's many of the relationships or curves. ERM is primarily about decision support, building and evaluating business cases. So in this case, there's no assurance or monitoring here. They're pulling data from the organization. They're doing a lot of crunching, and they're providing the conclusions of that crunching everywhere to line management to support their business cases, to the CEO to support their decision making, and potentially even to the board of directors to help them understand the risks and the proposals that are put in front of them.
Can you just give an example or two, or you may be going into this, but can you give an example or two of some of the models that such a modeling expert might provide either to the CEO or to the organization to help support their decision making, and how those two might be different?
Well, this is a part of the business that might run things like Monte Carlo simulations and develop
Hmm.
tornado diagrams, or develop curves or models, crunch a whole bunch of data and transform that into something that allows you to, identify your efficient frontiers, or optimize how much you're spending, or compare alternative A in terms of alternative B in terms of expected value and different degrees of confidence about your outcomes that are in the business case. That's the kind of work they would do.
They might have to do with risk-adjusted return projections for the CEO and things like that.
It could, although we'll come back to that, and there's a different model that might also get into AROC calculations as well. The calculations of risk-adjusted return are here. They're not normally someone that's involved in setting thresholds for those things, because that's a bigger policy question. The
Right.
modeling experts generally don't develop policy. They are support resource for folks who develop policy. That's why I put them in the bottom white quadrant. They're tactical. They're not strategic. They're not authoring policy or establishing strategy. They're giving useful models to help decision makers make better choices. So you have a homogeneous decision frameworks. You have a decision support center of excellence, consistently applying models to similar areas. And you have face validity. It looks good. You've got all these nice tornado diagrams and curves and indices that impress people, especially if you've got an organization and a C-suite with a lot of quantitative enthusiasm that like curves and indices and stuff like that. So if you're run by accountants and engineers, this is a great function to have in place because they like things like this. There's some other benefits too. There's a bit more objectivity. because you're using more data-rich processes. It provides some comfort when people are placing large bets, so it can help build and rally support around what it takes to move into a direction. It's a good fit for large, complicated, multi-tower organizations. Some cons. So folks who know how to do this don't grow on trees, right? We're talking about highly sophisticated mathematical modeling capability, PhDs in math. They're not everywhere. And they also need a good understanding of the business and able to do their business, that modeling properly. And now, more importantly, is we're introducing a new risk. Remember, we were talking about transformation of risk before? Now we're introducing model risk. The decision makers might trust these models too much, or perhaps they don't understand drivers and can't see if a change in direction or environment introduces a discontinuity that invalidates the model. They're also not so useful for extremely rare extreme events where there's limited precedent or historical data. You can't, if things like X, whatever the risk is you're concerned of, haven't happened, there isn't a lot of historical precedent, there isn't much data for these folks to work with. So it's not much good for that. Now let's talk about our friends on the bottom left, the strategic controller. So they are strategic, but they're an assurance function. So what does that mean? They will do things like sign off on major decisions. They are a second set of eyes, a sober second look. There is a natural tension between them and the CEO and executive line managers. They will answer the question, are we sure we've done our homework? They'll provide a view of risk that is independent of line management's. They also might calculate things like established standards for things like you mentioned, risk-adjusted return on capital or RAROC type calculations. Establishing those standards might come from a strategic controller kind of group to set the rules for big bets. So there can be a policy role as well as that sign-off activity for a strategic controller type function. So in terms of their relationship with management, they have a solid line reporting relationship to the board or other risk committees and a dotted line to the CEO. They can be a resource to the CEO and management, but really their primary focus is on board and compliance. So they're not really supporting decision making, more they're testing it. So some benefits, of course, you've got this thing called objectivity and assurance. You've got the belt and suspenders in terms of the major bets. Take a beat. Be sure we're doing the right thing. There are some cons. It can weaken the sense of management accountability. Again, if a risk is mismanaged, whose responsibility is that? It's another not great for building your Christmas card list kind of job, right? Because of the tension that's involved. They need to really understand the business. So you got to have some smart people who have deep knowledge of the strategic drivers in the business. It's very resource intensive if done well. You need a large group of people who are doing a lot of work because you are effectively calling the CEO wrong. You better be sure that you're right about that. And the other thing is that it's not strictly a value-added function, right? You're not really enabling decision making. You're just preventing mistakes from happening. Now let's move to the top right corner. So this is a strategic function that is a support function. So their role is to influence other people. So they inject into business processes. They make tools and encourage their use. They take decision makers through processes. They facilitate sessions. They devise thought experiments. Typically, a strategic advisor will work closely with strategic planning and then may even be looking at the flip side of the strategy, which is risk appetite. They're not independent at all. They have a different kind of relationship with management than the other function I talked about just a minute ago. They provide a safe place to talk about risks. They encourage open communication up and down the organization about risks and controls. So I talked about my least favorite English word, culture. Unfortunately, there's no other word to describe what I'm talking about, where you've got some transparency in terms of willingness to communicate ways we might get into trouble to the boss and work together on solving it. Those are the kinds of tools that strategic advisors are here and focused on doing. I should mention, by the way, we talk about board and executive activity. Executive here is not just the C-suite. They may interact with any decision maker who's in charge of something important. So in fact, this kind of ERM function, where they're focused solely on board and C-suite, those functions tend to wither and die with time if they're not working closely with management at all levels and not just C-suite. So part of their function, in addition to supporting the CEO and the C-level executives is to break down silos, to get the functional leads for all the functions together and talking about risks and the best way to exploit or avoid those risks. So in terms of the relationship, the solid line here is with the CEO. They're not independent of the CEO. To boil it down to one thing, they help the CEO understand risk and talk to their board about it. And do the same thing for others. Help others in the organization also talk to their bosses and peers about risk. Note, for good governance, there really must be also an effective, independent, some kind of assurance type function. So if your ERM function exists only in the strategic advisor quadrant, somebody in your organization should be thinking about some entity somewhere who's going to test controls and allow management to have some confidence that the things that lead up to decisions or the way they're being implemented is being done in accordance with their expectations. And that's the role of an internal audit function. So benefits. Because it's more about dynamic model building and challenge, you avoid the model trap that comes from the bottom right quadrant, right? You're building new, bespoke, one-off, custom-built models or methodologies to evaluate decisions. So this is the kind of function that I was in when I was the head of risk management at Hydro One, and we hardly ever did anything the same way twice. We used the same tools, but in terms of figuring out how to support a decision, there was always a process of saying, okay, what models make the most sense for this? So we're not really captive to some kind of very expensive statistical model like happens in the modeling expert category. The other thing is that unlike the strategic controller, this function makes it absolutely clear who owns the risk. It's the chief executive, right? And it's line management. Some other advantages, the positive culture impact over time. So you're building that comfort with talking about truth to power. It's relatively inexpensive. So strategic advisor function risk management groups tend to be relatively small groups. You don't need a lot of people to do this, which you need is smart people. There's some disadvantages. You're dependent on effective sales. It takes nerve and creativity. You are trying to build relationships and trust with decision makers all over the organization. And the other thing I should mention is that people will sometimes stumble over the not independent part, especially in some services. So Scott, during the introduction, you mentioned the fact that I have been a guest speaker at Harvard Business School. I was invited in for their MBA program, speak to a bunch of really impressive executives from some of the biggest companies on the planet. And in particular, I was talking about this role. And one of the things I said in the context of those remarks was that a strategic advisor, it should not be escalating risks, right? They're there to help management figure out how to escalate risks. So if I was aware of a risk that wasn't well understood, I would not escalate it. I would encourage decision makers to do that. Some of the very, very smart people that were in that beautiful oak-clad lecture hall at Harvard were aghast at the idea that I would, if I understood a big risk,
you knew a risk, but you wouldn't escalate it. Yeah,
that I wouldn't escalate it. So this can be a tough thing for some folks to swallow, that you're still effectively serving governance. The counter argument I say is what you're trying to do is build trust. And I'm reminded of I was at a conference a long time ago, early 2000s, 2002, 3, 4, something like that. And there was a recently minted chief risk officer, head of risk management, who got up during the Q&A session and was sharing some of their stories. And they talked about how they uncovered a part of the organization where they were just taking wild risks with the company way outside of their normal risk appetite. And they said proudly, I got that guy fired. And I thought, man, you're done. What is going to happen the next time you go into a part of the organization and ask them to share transparently with you their views on risks so they can figure out how to talk to their boss? Like, you are done. So that's part of the counter argument to that whole thing about independence and non-escalation. Okay, so usually risk management functions don't just fit neatly into just one of these quadrants. You can combine strategic controllers and compliance champions. Sometimes strategic advisors will also have modeling groups under them or decision support groups. But here's the thing. Here's the thing. You can't straddle the barbed wire. If you try to be an assurance function and a support function, if you're trying to be both a cop and the priest to whom people confess their sins at the same time, you will effectively run into trouble. If you are If your function is primarily to tell the higher ups how well management is managing risks, but you're also expecting them to be transparent and open with you about those risks in the context of a workshop or a thought experiment, you're going to run into troubles in terms of building trust. So it's important to decide which side of the barbed wire fence your function is going to be at. So in summary, I have 3 points to consider here. The first one is the context and role of risk taking. What is the role of risk taking in this company? What kinds of risks are we exposed to most and most concerned about? How dynamic and complex is the environment? Secondly, we need to complement what we're good at. In fact, even steal from them. Use the language and concepts of those other control functions that are effective. And above all, do not try to duplicate or transform or torque anything else that's running well that's either a risk management or assurance function. And again, stay out of the barbed wire. Do not try to blend assurance and support. One thing that's not on this slide, which is probably obvious, is that, and I might have said this at the beginning, I forget, this isn't entirely your decision, right? Most people don't get to decide what their own job is. You get to influence it. So when your CEO or CFO set up your ERM function, what did they hope to accomplish? Do that. The end.
Let's go back to barbed wire, please, because I want to tease that out. That's and just make sure that we highlight that and we understand that completely. So, on your barbed wire quadrant, when we have these 4 risk functions that we're talking about, these are presumably not always present in organizations, maybe one of them, maybe 2 of them, and presumably they have to be fulfilled by different people, at least on different sides of the barbed wire. How is this normally, how are these roles normally fulfilled in organizations that you look at? Do they often have both an assurance and a support function for risk? Is it mostly just assurance? Are these, do they have different kinds of people representing all 4 groups? Is it just, how does this manifest in organizations that you've worked with?
First of all, I would say I would describe everything that's in the lower half of the 4 model, the 2 bottom quadrants, as optional.
Okay.
Not every organization necessarily needs to have either a
compliance champion. Yeah, we can go back.
Champion.
There we go.
Thank you. Yeah, let's go back and get that slide up. Not every organization needs to have compliance champions or modeling experts, right? Remember I said compliance champions are about where you have a bunch of decision makers all over the place dealing with complex risks. You need some kind of comfort that they're managing it in a consistent way. So you establish standards that governs their behavior. And modeling experts, when you have risks that are where you have tons of data and you have risks that make sense to trying to find a curve and model your exposure to those things to support decision making. So the bottom half is not necessary. Somebody somewhere should be doing some kind of assurance function in terms of risk management. So there needs to be something left of the bar. It doesn't necessarily need necessarily though to be about risk. It can just be about control.
Yep.
Right. So typically the role of an internal audit function is to verify that internal controls are operating in accordance with management's expectations and perhaps best practices. They're not necessarily going to be a second opinion on risk. So in some sectors, there's a regulatory expectation there'd be a function like that, right? Like in financial services in some jurisdictions, for example. So you need something in, and often in banks, what they term the CRO will be in that top left quadrant.
Yeah.
I guess my point is, it's also a good idea for a bank to have somebody doing what's on the right-hand side, which is really more classically about sort of the Mike's Kaplan definition of what ERM is about, a challenge function that's not in your face, but is complementing other things, right? And is introducing tools to help drive better decision-making, more conversations, and better prioritization.
The elements on the left side of the barbed wire there, how is that? Is that the same as internal audit, or does internal audit live outside of this model? Do you see what I'm saying?
Internal audit should live outside of this model.
Okay.
Yes.
But it is on the assurance side, certainly. It would be off of the left of this model.
remember, strategic controllers and compliance champions are often involved in establishing policy, setting limits, particularly compliance champions. And internal audit can't both establish
Yeah.
policy and then audit
And
compliance
enforce
with it,
them. Sure.
right? Strategic controller, if all they're doing is signing off on big decisions, they're not developing policy about what the hurdle rates are for return on investment, that kind of thing, then they might be able to be combined with internal audit. But you certainly can't have them establishing policy and then auditing compliance with it.
Right. So your story about the newly minted CEO, excuse me, CRO, who found somebody who was taking wild risks and got them fired. And your
Yep.
point was you have smashed all trust with anybody, working those desks now because they're going to hide everything from you, right?
Yes.
What would have been the appropriate role to deal with that? Presumably, some kind of compliance champion or strategic controller would have found that information. But how, in that case, presumably they would be hiding these risks from any kind of cop-like function. So how using this model, what would have been a better way to address that situation?
So I've encountered those kinds of circumstances at least once, and if I think more deeply about it, a couple of times. But certainly one comes to mind where uh, I was invited by the executive sponsor for a large technology project
Hmm.
to do regular risk assessments, to facilitate risk assessments of the project as a service to the project. And very, very early in the project lifecycle, it came to light that effectively the project was in very deep trouble. They'd burned through all their financial contingency and they hadn't actually built anything yet. They were not
Okay,
being transparent about their status with executive decision makers in the organization, or hadn't been. So their PMO was doing things to conceal the problem.
got it.
Okay, so this is a classic case of what, well, if you were on the left-hand side, you would escalate that and something would be done with it. But I was on the right-hand side, I was a strategic advisor. So what that led to was a conversation with that executive sponsor afterwards saying, look, here's what we unearthed at our risk workshops we've done we did about 5 or 6 workshops over the course of a week with a variety of stakeholders involved. How can I help you communicate what's going on to your bosses so that you can get what you need to get things back on track? Because clearly it's not on track. So, and then we had that conversation. I helped them package together a package to communicate the risks. Ultimately, they were 6 months later, they were no longer with the company. So the end result was the same. The
Hmm.
project got back on scope, but we did it without without betraying that contract that I had with the project sponsor, that I was there to help them figure out their problems. So what a structured tools-based analytical approach to looking at a project or initiative or a part of the business, even if it's in deep trouble, helps you provide the language to say to the bosses, "Hey, I need help here." Right? We have a problem, and I have now an excuse to tell you about it, bosses. Right? It gives license for decision makers at all level to share bad news with their boss. And that's what I encouraged that executive sponsor of that project to do with their bosses. And it didn't work out all that great for them in the short term, but in the end, it was certainly good for the governance of the company, and it was also a very good success story for our function because we managed to stay right of the barbed wire and still help the company avoid a disaster.
So um, when we talk about who should escalate risks, right? So when we talk about line managers and transparency and the idea of if you see something, say something, right? Which of these roles, it would have to be on the left-hand side, I'm assured. Is it a compliance champion that helps create an environment where it's okay to raise these things, or is it the strategic advisor's idea of creating the environment where transparency is safe and it's okay to escalate these things on your own? Help me through that.
That's more of the two on the right hand side is about
Okay.
helping facilitate communications up the line in terms
Hmm.
of risks and responses to risks and what risk is left over. I've talked a few times in the past on webinars about the sacred conversation, right? A good, healthy risk, here's the word again, culture, is one where there's some periodic conversation between every boss and every one of their subordinates at all levels, including the CEO, which is to say, here are my objectives as I understand them. Here are the principal risks to the achievement of those objectives. Here's how I'm allocating the resources that are available to me in order to manage those risks. And here's the residual risks that I'm accepting going over. Are you okay with that? And the folks on the right, to different degrees, are enabling those kinds of conversations. The
Right.
folks on the left-hand side, less so. They don't preclude that. There's nothing. If you have nothing on the right, you just have compliance champions. That doesn't prevent people from communicating risks and exposures and allocations, but it's not really about explaining risk-based decision making. It's
Mhm.
about imposing standards that have been decided for you about how you're going to manage risk exposures.
And the transparency obviously has to be assured, right? So in the case where you were just highlighting, for example, if there was a compliance champion, presumably data would have been hidden from that compliance champion, or was there just nobody who was responsible for checking on those standards?
There was nobody who there would their internal audit hadn't been in there yet looking at that
Okay,
project. If they had, they would have discovered all kinds of
got it.
stuff. But there was no, they hadn't, there weren't detailed standards and requirements in terms of how to manage that particular kind of project and how to manage through those decisions. So there was no one in that bottom left quadrant.
Got it. Okay.
And I don't even think one was warranted in that case because it's not like the company at the time was doing a ton of these kinds of projects.
So, um, as final thoughts here, but I want to give you some time to elaborate on this. One of your great concepts that you've brought up many times at Risk at Work in terms of grafting ERM onto an organization and making sure that it has endurance and making sure that it thrives, is your concept of finding the cool kids and giving them sneakers, which is to say, finding crux points, people who act as crux points within the organization, either decision makers, influential line managers, things of that nature, and helping them with the tools generated by ERM, sometimes models, sometimes other things, to do their jobs more effectively. And I wonder how, presumably that fits into the right-hand side of this model, right? Presumably that the people who are modeling experts or strategic advisors are not only creating the terms of transparency where we can have conversations about risk, but are also enabling not just the CEO to make decisions, but I think you already said line managers to make decisions and core decision makers to make decisions. Can you elaborate and give some examples on how people, from this model would interact with line managers and help ERM be endure within their organization by giving some kind of tools or help or assistance to to departments to help them do their jobs better?
So we got started doing enterprise risk management at Hydro One in 2000, and it's now 2025. So it's 25 years later. We've had that organization has had numerous CEOs, turnovers of boards. They went through an IPO. They're now a publicly traded company. There are entirely different staff involved in running their ERM function. And yet ERM still exists in that organization as a part of the DNA of the way they run. So why is it that way? Well, it's this cool kids concept, and it's about integration. So we focused on a couple of areas of the business which were ripe for support and integration. One was about investment planning. So for utilities or any business that has distributed assets and a capital and O&A budget, and their job is to keep those things running, um, the central decision-making process is how you decide where to spend each dollar. Is it going to go to which assets, which asset types, what manner, when are you going to replace things, when have you decide when are you going to try and refurbish them, all that kind of sub-optimizations of different things and knitting things together. So that was one of the first things we really focused on, is how to use ERM tools. In our case, a large part of it was highly developed impact criteria and a methodology for applying them to drive investment optimization. And the other was about major projects. And I think our experience that I talked about before in the early days, just a minute ago, about that project blowing up, led us in that direction to develop more and more capability to support effective project management and influence. There wasn't then when in the early days, but now they have an EPMO function, a center of excellence on projects, and it's about marrying those things together. So it would be very difficult for an incoming CEO or board to rip ERM out of that company, right? It is
Mhm.
a part of how they do a couple of the really central things to the way they operate. And the way we got there was by focusing attention, having lots of cups of coffee with the folks in charge of investment planning and the folks in charge of the center of excellence in project management, and understanding what they're trying to accomplish and not trying to accomplish, and how we can complement those things. Now, it sounds when you hear me talk like I'm just talking about the strategic advisor role, and I think it actually applies to varying degrees all four of the quadrants.
Okay.
So a compliance champion, a compliance champion is only going to develop standards and requirements if they're empowered to do so by someone who's in charge of that function,
Mhm.
right? So they're still a cool kid, and you still got to give them sneakers, and you still got to convince them what you're doing is effective. And certainly the modeling expert, you're going to be integrated with some other decision support or finance or some other entity within the organization that has a need for, folks with lots of letters after their names to do all that kind of modeling and support their decision making. And then, of course, this is very central to strategic advisor. I'm not so sure about strategic controller. I don't think it's quite so important that someone in that quadrant needs to invest a lot of time figuring out what the cool kids are, because they should accept that sooner or later they're going to annoy the hell out of those people anyway.
Even just as an annoyance mitigation
Yeah,
kind of cup of coffee, right? You know.
that's why I think Canadians would be very good in the role, because we're very good at saying sorry.
Last
Right?
question for me.
Sure.
Where do you see the most need for help or change in organizations from this? Does it have to do with straddling of the barbed wire? Are there meaningful deficiencies where a strategic controller role is missing? Where do you see the most opportunity for improvement in terms of applying something like this model? Or
In the early 2000s, ERM developed in a large extent as a side dish to internal audit, which is a terrible place for it to be. And I have noticed in some sectors a tendency and then people figured that out, and it went other places. So you saw
Mhm.
risk management or reporting to the general counsel or CFO or some other function like that. There has been a trend more towards recombining those functions because people think it's more efficient, and people naively think the tool sets and capabilities are common, and they're not. A good internal auditor is not a good risk manager. They're very, very different skill sets. Um, and I'm not denigrating internal auditors at all. I did that for a while before I got involved in ERM, but there's just a different capability involved in those two functions. There's a different focus. Um, the other thing is about that I don't see anywhere near enough thought about business process integration. The thing we were just talking about investment planning
Yeah.
or supply chain. I mean,
Yes.
um, that's another area that's super ripe for this kind of thinking, where we apply tools to prioritize different buys. So, which ones are A, consuming a lot of resources, and B, where the consequences are big if we don't do them well, or where there's a lot of change and agility is required because
Yeah.
there's rapid change in the technology of the thing we're buying, and using analytical tools to support help help the folks in charge of those processes understand the risks better, but perhaps more important, help them tell their story to the C-level executives so they can use language that's already recognized at the C-suite level that says, "Oh, okay, this risk is a blah blah blah. We should apply." You know what I mean? So they're
Yeah.
accustomed to that kind of thinking, and that lubricates that whole conversation. So if they run into trouble or they need to reallocate resources, they can do it using a language that senior executives understand.
Fabulous. Rob, thank you again for joining us today. I always love our conversations, loved getting to learn from you. I appreciate your methodology here and your insights, and they're obviously extremely valuable as always. And to our audience today, thank you very much for spending an hour with us today. We look forward to seeing you again on our next installment of Risk at Work. Take care.